Hello, I'm Sammy Blake, Client Portfolio Manager at npower's Optimization Desk. Welcome to this week's market update. A colder start to last week meant near-term power and gas prices found some element of support at the start of the week, as the bearish sentiment which has gripped markets over recent weeks was fairly halted. In addition to that as well, there was some speculation midweek last week that Groningen gas field in Netherlands would curtail production due to links to local earth tremors. And this also meant support for power and gas prices on the near term. These all, however, proved short-lived during the week, as eventually mild weather did set in into the UK. The UK also continues to receive fairly strong levels of gas imports from Norway through Langlet pipeline. And then in addition to all of that, our storage levels remain very healthy, about 85% full compared to 78% from last year. Market reaction to the Dutch Groningen production cuts were largely overdone, as final confirmation on Friday did show higher production levels than had been priced in by market participants. Hence, most of the gains were given up by Friday, with longer dated power and gas contracts finishing the week largely mixed. In the oil market, bearish sentiment did prevail as a deal between Iran and the West moved much closer, with a date announced for the first phase of lifting economic sanctions against OPEC's second largest oil producer. This basically raises the prospect of higher global oil supplies and as a result put pressure on the oil market. The losses were, however, tempered due to mainly the ongoing concerns regarding Libyan oil production, as well as data midweek, which showed that US crude oil stocks fell far more than had been expected by the market. So the outlook for near-term UK power and gas markets remains weak, with temperature being the only outlier. Gas storage levels in the UK are very healthy. The power surplus is also very comfortable, especially given the strong contribution of renewable generation. This all means that unless we get an extended cold period for the rest of this winter, we are looking at the prospect of lower gas requirements for this summer, hence prices are likely to be kept low. For longer dated prices, some direction will continue to come from movement on the nearer term contracts, but with the prospect of a growing global economy, it will be very difficult for longer dated prices to shed as much value as their near-term counterparts. Finally, in the oil market, with the deal now in place with Iran, focus will turn to Syria, where you've got negotiations happening between major oil producers and consumer nations. You've got vested interest from producers like Saudi Arabia and Iran, as well as major consumers like the US and transit nations like Turkey. Hence, the outcome of any negotiations there will likely impact the wider energy market. So to recap, unless there is a sudden bout of colder, extended weather across Europe and in the UK, there is very little reason for near-term power and gas prices to move higher. While for longer dated contracts, geopolitics in the Middle East and global growth hopes will keep contracts largely mixed. If you do have the right risk management tools and services though, you will be able to manage your prices exposure. If you have any questions on anything I've touched on today, do contact us using the email address below. Thank you for joining us, and hope you do so next week.